Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Today we've got a busy schedule. We've got to talk about Bitcoin, the stock market, and monetary policy. We'll also dabble in some derivatives, some futures markets, and try to bring everything together. And prices this morning are moving quickly as I record this, so some of what we talk about today may be invalidated by the time you see this video. But alas, we have things to discuss, and we can't quit just because the market is tough. So onwards we go. If you enjoy my content, make sure to give my video a thumbs up, and please subscribe to the channel. I greatly appreciate your support, and it allows me to continue doing what I love. So without further ado, let's talk Bitcoin. So yesterday, the Federal Reserve delivered precisely what the market was hoping for, a 50% basis point hike and announcement of QT measures that fit within the expectations they laid out in previous meetings. And the market, as an entity that runs on certainty, pumped yesterday afternoon on the news. Now, sitting here this morning, equities have been open about an hour and a half, and they are selling off pretty aggressively. The S&P, as of this moment, is below the open from yesterday and continuing to sell off. I don't know that we'll actually get down here and threaten the current year-to-date lows, but this isn't a good look for the first couple hours of the market. Though what we've been seeing recently is equities will have a certain move in the morning, and then by the afternoon, that move gets erased. So I'll be watching this, but there's a good chance that by the time 2 p.m., 3 p.m. rolls around, that this bottom of this candle is a little bit higher up. We'll keep an eye on it. For the FOMC's part yesterday, it was exactly what the market was expecting. A 50 basis point rate hike, quantitative tightening beginning in June at a pace of $47.5 billion per month and increasing in September to $90 billion a month. Now, that sounds like a lot of money. It's certainly the most aggressive quantitative tightening schedule the Fed has run in dollar terms. And we'll have to watch how it plays out over the next few months to see if the Fed sticks with their plan, because a lot of this hinges upon the inflation print that we get next week on May 11th. That's when we find out the April CPI print, and if it ends up being worse than the 8.5% we got last month, all of the guidance that the Fed gave us yesterday is subject to change. The market will become more turbulent, and we'll have to reassess what we think monetary policy is going to look like. But the Fed, for its part, and using its own words, expects inflation to lower down to 2% at some point. Now, I think that we are a long way away from that, and I have a suspicion that they will end up being vastly wrong about inflation. But that doesn't mean that we won't see a temporary reprieve in the year-over-year change, because we measure CPI in a year-over-year comparison to the same month from the year before. We're at a period where inflation last year was really starting to increase. So the year-over-year comparisons have been at a really tough point for the base effects of CPI. But we're reaching a place where the prints last year leveled off before accelerating again, and that may provide temporary relief to the rate of change of inflation. So if that happens and we get a somewhat softer print next week, I think that we can safely assume the policy expectations for the Federal Reserve are probably static for at least the next month or two, because they don't like to pull surprises. They've been preparing the market for their intentions months in advance, and there's no reason to think that they would deviate from that trend if things started turning for the worse. If they started to think inflation was getting worse, if they thought that maybe they had miscalculated on its rate of reduction, I don't think that they would come out and surprise the market with a 75 basis point hike, all of a sudden more aggressive QT, and not have prepared the market for it in advance. So with all that said, my base expectation over the next couple of months, assuming inflation doesn't come in higher next week, it hinges upon that. If that ends up being the case, I think June and July may be a period of mild optimism. Now, there is a lot going on in the world, friends. I am not immune to the very complicated geopolitical and macroeconomic climate that we are in now. I'm finally aware of it. But markets themselves move on certainty. uncertainty. At all times, investors are pricing in known information into the future and pulling it into present valuations. That's going on at all times. And now that the market has a general expectation of the next couple months of monetary policy, they can proceed with commerce assuming those conditions will be somewhat sticky, at least for the next couple months. Now, I know that's hard to bank on in the world we live in right now. When we've got the war in Ukraine and all of the possible commodity issues that stem from that complication, when we've got China pursuing aggressive lockdown measures in a vain theatrical attempt to show control over COVID and its effect on supply chains, when we've got the Bank of England continually raising their core interest rates and warning their citizens about recession later this year, there is much to be concerned about and to be prepared for. But at the same time, nothing happens in a straight line. Nothing sells off in a straight line. Nothing appreciates in a straight line. And we've been relatively down for a while now. We're vastly due for a brief reprieve to the upside. So I think that if it's going to happen, if there is a climate, this is the climate for it. Now, we've finally gotten answers about quantitative tightening. We finally found out that the Fed did raise 50 basis points. And yesterday during the press conference, when asked directly, Jerome Powell said that the committee is not seriously considering a 75 basis point hike at an upcoming meeting. He basically threw cold water on additional hawkishness. So my interpretation of what we saw yesterday is that we have a Fed that is pleased to see the markets tightening on their own. Through expression of rhetoric and hawkish posturing, the Fed has gotten the markets to de-risk and tighten themselves, particularly the bond markets. And I think yesterday they showed that their posturing was successful. They've seen a tightening of conditions without having to use the blunt instrument of policy tools. And now they are embarking on the very slow and painstaking needle thread process of trying to raise interest rates a small amount at a time without completely breaking the economy. Now, with slowing growth expectations, the chances that we enter a stagflationary environment with slower growth and high inflation is very real. And we're probably in that environment now. So what I think that we could see, and speaking specifically about Bitcoin here, I think that because it bottomed out so much earlier than equities, if we look at the indices, you see where Bitcoin's bottom was in early February. Well, the indices, they didn't see their lows until March, and recently with the S&P, just at the end of April and beginning of May. Same thing for the NASDAQ. So we saw Bitcoin bottom out much earlier, and it's been able to maintain relative structural integrity. In the last video, we talked about the possibility that price may get down into this region down here. I still think that's very possible, especially as we watch this candle right here threaten the lows of this smaller channel that we're in. At any moment now, it could break down below this, and it may as we're talking here. Yep, there it goes. Here we are breaking down into this lower channel live on camera. Now, what I think we may get as we're seeing this bottom fall out, I would expect to see some resistance down in this area. I would expect 35K to hold. And if it does hold, that would retain structural integrity off of this lower low that we got in February. This is what we talked about in the previous video. So it's my current base case, and it's what I'll be watching for. What I wouldn't like to see, what I wouldn't want, is to see price action below this level, because that would be a market structure break, and it would suggest that we would have additional downside on the menu. Even though this is very scary, and this is a hideous candle, there's no two ways about it. There is room for this to continue to deteriorate without a destruction of market structure. People out there may label that as hopium, but this is pure probabilities and market structure 101. Don't break into lower lows, and lower lows are right here. So that's what we're kind of watching for price to chop around in this range here and then find support back to the upside. Obviously, a candle closing down here here invalidates everything I just said. And if we were to break down here, I think that this level is not long for this world and would probably be lost in quick order, at which point we would be looking all the way down here at range lows. But we're not there just yet. I would have to see significant liquidations before I started to feel like we were going to go down there. And it's highly unlikely that we're going to traverse $15,000 in a single day. It hasn't happened before. I don't know that today is the day for it. And one of the reasons why I think it would be difficult to see a full-on liquidation cascade down to the lower 30s or down into the 20s is because we don't have the same market conditions in place for previous times when we've had major liquidations. And one of the ways that I can make that point is by showing you the futures perpetual funding rate. So this is a metric that we used to explore quite a bit on this channel until macro took over the landscape. And now the funding rate is a way of governing the amount of bias that exists in the futures market and a way of enticing balance between the traders in that arena. When you have an aggressive bias towards the short side, a lot of traders positioned for price to go down, the funding rate goes negative and it charges those short traders a fee for being on the majority side. And that fee is paid to those going long as an incentive for them to provide liquidity and backstop the other side of the trade. Likewise, when there is an excess of long leverage and long bias in futures, we get a premium, a funding premium where it goes very positive. And in those cases, long traders are being charged a fee that's being paid to short traders to incentivize their taking of the other side of the trade. It goes both ways. Now, when you look back at the spring months, and this is a dynamic we've explored at length at various points on the channel, we had very high positive leverage and positive premiums in the first half of 2021. And even in the bull run in October of last year, we started to see another positive premium regime. But in the months following, the funding rate has really muted itself. My drawing tool on here. And the thing to remember about the funding rate is that it has a baseline value of about 0.1%. And that's because a couple of the exchanges calculate their funding rate with a method called a clamp, where if there's not enough volume pushing in either direction, the funding rate defaults to kind of a baseline positive value of about 0.1%, a very small fee. And over the last few months, funding has really been tightly contained in a small range, which is quite different from what we've seen at previous points, right? Where funding has really gone positive and even heavily negative at times of intense bearishness. But instead, we've been seeing it pretty much corralled into a tight range. But what I've noticed today is, and it's very imperceptible, it's almost hard to notice at all. So I'm going to zoom in a little bit here to give us a better look. This funding rate now, as you can see, has spiked up and it's currently at the highest point it's been since back here. This was in December when we last had funding even above the 0.1% baseline value. You can see it's been subdued down here for a long time, which is indicative of consistent shorting behavior and a lack of aggressive longs. But just here in the last day or two, we see funding creeping up towards the positive, printing a couple of consistent green bars, and now touching this 0.01% value, which it hasn't seen since December. I'm not getting ahead of myself. This isn't showing that there are leveraged longs. However, it is showing a slight change in the trend that we've been observing. Now, when we look at open interest as a whole, the total of all the open contracts that sit in the futures market, not just in perpetuals, but also in the calendar futures, it is still elevated. If you see over here, this black line represents 2% of circulating supply. And recently, we've had open interest hovering above this level. Typically, when it gets above this level in the past, it has resulted in liquidation cascades and a flushing of leverage. 2% is not any kind of mechanical level. It just happens to coincide with a point where futures open interest is considered to be at a high cabin pressure. You can see here, when open interest is above this line, it doesn't stay there very long, and it usually ends with a dramatic flush down below 2%. You see, it happens here a bunch. But recently, in recent history, we've kind of crept back up and been hovering around this level. And we're not seeing heavy liquidations because we don't have a lot of longs in this market to get flushed out. There's a lot of shorts here, but we don't have the kind of strength to the upside that would force them to close their positions out. So instead, a lot of these traders just get to sit in their positions. They're not forced to close. Some of them may close to avoid paying the funding fee, but generally positions are sitting open. And when we look at the funding rate with a Z-score, which gives us a way of determining deviations, in this case, I'm looking at a 6-month Z-score. What it's showing about the recent action on the funding rate is that it's deviating to the upside from its recent trend. We've been stuck in this little box, just as I described to you. And we've been stuck in there for so long, this move now to this positive move in funding is a relatively mild move. When you look at it in the context of deviation, it's a deviation to the upside. So maybe this is indicating to us that we're nearing the end of this long period of consolidation and that we may, if this continues to play out, be entering a new regime of more volatile funding and perhaps a little more action in perps. I don't know if that's actually going to play out. I might be reading too much into this movement here, but considering the consistency of this trend, how solidly we have been contained within a relatively small box for funding, seeing that's now deviating to the positive suggests to me the trend could be shifting. To further corroborate that we think the trend is shifting, down here at the bottom is my perpetual basis indicator. So we've talked about this on the channel a number of times. Those of you who are familiar with my visit on Blockchain Backer's channel, this indicator was discussed on my visit there as well. And what this is really showing is the difference between the spot markets and the perpetual markets in terms of price. When you see steady negative values, which are green bars on my indicator, that is showing that the perpetual market is behind the spot market, that Coinbase has a higher price than the perpetual futures. And that usually happens when either there is heavy bidding pressure in the spot market, which is pushing it ahead of futures, or there is general bearishness and selling pressure in the perpetual market, which is holding it back and keeping it behind the spot market. That trend was really consistent for many months. I have tweeted about this. We've talked about this on the channel. This trend has been really solid. Well, just in the last few days, we're actually starting to see a perpetual basis flip. This is showing positive premiums. Now, the reason I think that this is happening is because of spot selling. We're not seeing aggression in perps. You know, the open interest has stayed pretty level. And when you look at the way open interest fluctuates with price, it still suggests to me there are a healthy amount of shorts in that market. So I don't think that we've got suddenly a bunch of leveraged longs entering perps, but rather it is holding up and remaining relatively static while we're seeing spot selling. And it's enough to help create this negative basis. So again, this suggests a softening of the trend. We've got the basis flipping positive. We've got a Z-score view of funding rates showing a deviation to the upside, while we're seeing OI maintain its relative high level. It's not really breaking down, and we're not seeing high levels of liquidations. So the perpetual market, for all its purposes, appears to be relatively static while we're seeing weakness in price, which to me implies some spot selling. That's okay. We've explored the possibility that we can maintain market structure integrity, as hideous as it may be, with price dancing around down here. But I really wouldn't like to see it violate this February low, because I think at that point, then we're really threatening a visit down here to what would be the July lows. And I don't want to see that play out just yet. And if we can see that this trend continues to hold, if price does what we expect, which is hold this general level, and then over a period of weeks or possibly months, if it's able to make its way back up here to the top of the range, I think that this is a crucial area for price action. We were swiftly rejected by this level previously. This does mark the 200-day moving average, which you can see here in my purple line, but also even more importantly, it's this dotted black line right right here, which is the median of the macro range. This dotted black line going across the middle of my screen right here, which I will make solid so that you can see it more easily. This line is the dead center of the macro range. And it's also where we were rejected by the 200-day moving average. So this level here around 46, 47,000, call it 48 at the top of this wick, that's the level of true contention. I think that's where we'll really start to see these perpetual traders shifting their dynamic. We may start to see more leveraged longs on the battle to 50K. I've expressed this sentiment before, and when we saw price get hard rejected by this median here, it really enforced for me how important it is to get back over the macro range median. And if we're able to conquer that battle, which seems very far away at this point, it seems almost unrealistic to be talking about 50K prices in this current climate after what we've seen the last few months. But if we are able to do that, if we're able to start making our way higher, let me take off some of my indicators here so it's a little cleaner. We're able to conquer this level and get higher at some point. I do think that we will majorly contend with the retrace levels at 55 and 58K, and I do not expect these to be broken. My general base case since the beginning of the year is that we would pull down, we would do a retrace up towards the 702, and then we would go lower. Yes, I mean lower than July. That's been my base case since the beginning of the year. I still believe that's possible. And when I see how the economic landscape is unfolding, I am more convicted in my thesis than ever before. I think that we've got a couple of months maybe of chopping around like this. Eventually we make our way up to this retrace, and then it's Goblin Town. That's been my base case. It's valuable to mention that just because I have a base case doesn't mean that it will play out that way, but it creates a baseline expectation from which we can observe the markets and determine how accurately or not we are reading what's unfolding. So my base case is not meant to scare you. I've expressed these views before, and it's just important to make sure that what we're observing with the market is aligning with the way that we forecast the market, because that's where the true learning is. Make sure you're following me here on Twitter at TXMC Trades. I post a lot of my thoughts on here, a lot of my in-the-moment analysis. If you have any questions for me, if you have feedback for this channel, please leave them in the comments below. I read all of them. We'll give this market a couple of days to breathe, and then we'll reconvene and see what unfolded. If this price action is uncomfortable for you, if you're not able to see these charts without stressing yourself out, close them down and go enjoy your day, okay? Don't get stuck watching price, watching a kettle boil. That's just a way to get yourself worked up and create stress when you don't have any control over the market. And that's where we'll leave it today. We'll give this some time to play out, as I said. So until then, take care of yourselves, friends. Be kind to each other. I hope you have some lovely weekend plans, and we will chat very soon. Until next time, cheers, everyone.